All right, I believe we're live. I'm looking, it's 8:30. Let me look at the attendee list. So we got some people coming in. We got some old timers on here. So I want to thank everybody for showing today. We got a couple people from the office. I'm going to be mentioning some of your names. So I'm letting some people come in. Hey, good morning, Ken. Just waiting a couple seconds. We'll get started. Get through some housekeeping items as soon as I see the list grow. And then we'll get started. Hope everybody's enjoying this weather. See, is there anything in the chat? Oh, hey, Santo. I'm just going to mention you later on. Morning, everybody else. Good morning, good morning. We work all night through. Good morning to you. All righty. Now with that introduction, so today we're going to go over a different type of topic. No, it's not PPP. No, it's not taxation of it. No, it's not forgiveness. It's going concern. And you'll understand later on why we're going over this presentation and certain of the slides that are included in here. Some people may say it doesn't apply to me. I try and do this presentation to make it apply to everybody, especially people that are not in public accounting. When they hear audit phrase, I kind of turn it off, and you'll hear why I bring up audit as it affects you too. As you notice in the screen, again, we're using a different platform. I know that Colleen, who is the producer behind behind all these scenes, I don't know if everybody has met Colleen, but she's done a wonderful job with this. Has started using this platform for a while, and you'll see that there are two different functions up top. You have a chat and a Q&A. So in the chat, if you could just let me know where you're from, then let me know that you can hear me. Just want to see in the chat. And then in the Q&A, please only put your questions in the Q&A, because I watch the Q&A as we're going along. I generally don't look at the chat as much because some people like to give me their commentary and their opinions on things, and it will distract me. I'll bounce over sometimes, but I don't generally read through the chat as much. Colleen or whoever's in the background will look at it to see if there anything important shows up there. But otherwise, I will watch the Q&A. You guys know my style. I will answer questions as we go along. Today, the main presentation is going concern. If you want to stick around for a little bit longer, usually we go to anywhere from 9:25, 9:30. If we go to 9:45, we can get an hour and a half of CPE for those that need CPE. I'll instruct Valerie to do an hour and a half. We're going to talk about impairment. As I was going through this and thinking about this more, I knew that impairment kind of fit in with going concern and what we're going through. And you'll see later on as we're going through this. We will have polling questions as a requirement. You have to answer 75%. You're supposed to give 3 per hour. I usually do 4, and especially going to an hour and a half, I want to do 4. And the reason I do 4 is if you do 3, and if somebody misses one because they're in the bathroom, they can't get 75%. So I don't know who came up with that wonderful logic about 75% of 3 an hour. Anyway, so I digress. So let's practice it now. I'll do the first polling question just to get it out of the way, just to see that people are seeing it. It's under polls. You should be able to see it. Have you been discussing? Have you been having discussions about going concern? Is it showing? I started the polling. It doesn't look like. I don't know if it's showing. All right. Okay, so I know I did it, and let's see if people are responding to it. So you should be able to see the polls and how other people are answering, and then we can move on. All righty. So while that grows, we'll close it out in a few seconds. Just trying to see the number of people that responded. And then let's go to the videotapes. Okay, so going concern. As usual, I like to give my disclaimer that the views and statements expressed herein are my own and don't necessarily reflect the views of Sobel & Company. So don't call Alan and say, is this what your firm thinks? This is my view, especially when I'm talking, particularly like something about going concern. I'm going to give a lot of my thoughts on certain things. I will tell you that how I argue with the people in the office about it, how the partners and the managers and staff that work on your accounts, if you're a client of ours, how they like to help you and protect you, especially when I'm doing QC, or Liz in our office is doing QC. But that's our charge as QC people, to challenge certain things. So let's talk about a brief history of going concern. I won't read off the history like I'm a history teacher, but in March 81, SAS 84 came out. Then in April 1988, SAS 59 came out. And in July, SAS 126. So you see a trend here. SAS, a statement on auditing standards. Then in August 2014, ASU, Accounting Standard Update 2014-15 came out. Why am I just going through this history and pointing that out? Because you realize from 1981 and prior, the onus of going concern was placed on the auditor. The auditor had to determine if the financial statements were presented in a going concern manner. Okay? In 2014, well, it was prior when they started talking about it. In 2014, they said, this is not an auditor responsibility. The financial statements are the responsibility of management. They have to be making the assertion if the financial statements are presented on a going concern basis. The auditor has to audit that assertion. So they took it away from the auditor as their responsibility to make the ultimate decision and put it onto management. And that's why I wanted to have this presentation, especially to people that are not in public, for them to understand this is now on you. And unfortunately, then SAS 132 came out. And I'll talk about the SARS's. The SAS 132 came out and said, okay, management is now making the assertions, and now you have to audit that assertion, as compared to the past where we had to say, okay, well, Mr. and Mrs. Auditor, you kind of make the decision if you think that they're being presented in a going concern basis. So it has taken the onus from the auditor, kind of left still a responsibility with us, but taken it from the auditor and put it onto management. And that's why we as auditors are pushing back on this harder and harder as of late, and you'll see from the dates as to why. But let's sit back. I keep using the phrase going concern, and I'm not going to lie. SAS 59 that I talked about before came out when I was graduating college. And when I was in college and I'm hearing going concern, I've hated that phrase for years, okay? What is going concern? Going concern is the assumption, is a basic understanding assumption for accounting. For a company to be a going concern, for a company to be a going concern, it must be able to continue operations long enough so it can carry out its commitments, obligations, objectives, and so on. In other words, the company will not have to liquidate or be forced out of business. So as the picture says, so a going concern means it's going to continue in business. I've always hated that opposite phrasing. You know, my mind, a going concern is I'm concerned that it's going to continue going on. But in any event, and when I talk with people, either in the office or I talk with clients about it, and I say, we have to talk about going concern, and they're like, well, it's, I don't have any concerns. It's like, no, I have to talk about it the other way. So under the auditing standards, going concern is base of accounting. The financial statements are prepared on the assumption that the entity as a going concern and will continue its operations for a reasonable period of time. Oh, we'll talk about that too. Okay, that last part of it. So you just have to realize that when we reference that a company is a going concern, under accounting terms, going concern means that it will continue and be able to meet its obligations. Now, us in practice, most of the time when we say that something's a going concern, we're talking what we would think. So if you hear us using it, the phrase, and you're uncertain which way we're using it, stop us, stop me, stop anybody, and ask them to clarify, okay, which way are you saying it? Because, it's kind of, accounting sounds like it's kind of double speak right now. So who, as I said on the first slide, who is responsible? Management's responsible, the auditors are responsible, and the accountant for reviews and compilations. And one thing I hadn't mentioned on the previous slide is the STAR, Statement of Standards of Accounting and Review Services, addressed going concern in the past few years also. We'll talk about that later in the slides. Those that are not in public saying why, I need you to hear certain things as comments as to how we are servicing you and asking you certain questions. So as you see, management is integral in this process and responsible for this. So it keeps going round and round to you, round to the auditor, to the accountant, etc. So it's important that we have these discussions. And when we go through these next set of slides, you'll see what your responsibility is. And if we start asking questions, why we're asking the questions. So management, the ASU 2014-15 came out. This applies to all entities. Okay, so I know I looked over the attendees last night and I saw a handful of our clients, and a bunch of them are nonprofit organizations. Thank you very much for attending. And because in this environment right now, you know, with what's going on with the world, you know, and I serve on some boards. I was on a board meeting last night, and we've had these discussions, and they're dragged down because now I'm an auditor accountant talking with the board about going concern, and you have to see their heads start spinning. But it's important because the board our budget was built on break even at the beginning of the year, and who knew we were going to go through this? So it's important, especially for nonprofits, to know that this affects them. And of course, public and non-public entities. And when I say public entities, you think to traditional SEC, but there are others, and then non-public entities. So this affects all. This was effective for periods beginning after December 15, 2016. So if I'm putting myself in that bucket too, if we have not been talking with you about this enough in the past, I apologize. If somebody else that you work with hasn't been talking to you about this in the past, I apologize for them too. But this is something we should have been talking with you about, and you should have been addressing. So when the orders come out and I see people's names on here, like Mary Ellen and other people in the office, and they start asking about it now, you know, it's just something we're more attuned to. And we're thinking about now more just in general, because of inquiries and peer reviews and inspections that we go through that they ask about it, or because of the economy at large. Management, if you're into the codification and looking up FASB information, it's under Codification 205, if you so desire. Management's required to evaluate all annual and interim periods, reporting periods, whether it's probable the entity will be able to meet its obligations. How long? How long do we look? So if you go back, and I said hello to Santo before, he and I, your accountants, and we talk about stuff, and he probably remembers how long did we have to go. Well, you always had to go a year from the balance sheet date. That's what it always was. And whew, you held that draft till December 30th of the next year, and you issued it the next day, and who's going to make a day? I can make a day. That's easy. It was a year from the balance sheet date. That changed. And fortunately, it is what it is. When the original draft pronouncements came out of this, they were following some IFRS concepts. And you'll hear about it later on that said foreseeable future. Ooh, okay. But what it says now is the entity has the ability to meet its obligations as they become due within 1 year after the date the financial statements are issued or available to be issued. So you have people then trying to rush financial statements to get out, which is never good. And you have people holding financial statements because for certain reasons, which is also never good, because that extends a date. You know, it's like the statute never starts, but some people want to rush it, and then they get stuff, they send something out that might be premature without all pertinent information. So you want to make judicious decisions, but the important thing for you to know is that the old mindset of 1 year from the balance sheet date is gone. That's gone, long gone, or not long gone, 2014 gone. It's 1 year from the date the financial statements are issued or available to be issued. Okay, so if anybody has any questions about that, it makes it difficult when you have to start forecasting and looking and making projections as to what the possibilities are. And we'll talk about that a little bit more later on, but you'll understand why I keep emphasizing that. When management identifies substantial doubt, here's where the difficulty and the debate start to come in. When management identifies substantial doubt about an entity's ability to continue as a going concern, okay? and then you can read the rest of it. I don't think you enjoy hearing me read to you. It's not like I'm your seventh grade English teacher, but I'll read when certain things are appropriate. So that big phrase, substantial doubt, that's where this whole thing comes in. Where does going concern come about? Because there's substantial doubt about the entity's ability to meet its obligations. So substantial doubt about going concern when conditions or events. Okay, and in our office, when we talk about it, I say to when I'm either talking with somebody about financials, a lot of people on here know Bridget, and she sits right next door to me, and she'll come in and we'll talk about financials because we just have groovy conversations like that. It's like a hip environment. We talk about financials, and we say, she'll say, "What do you think about this?" And I'm like, "Hey, well, we just talk about conditions or events, and you have to think about what's going on." And where I'm going to mention it later on, so why don't we just say it now? COVID, okay? All right, there's a condition or event, and this is the big reasons why we're doing this presentation right now. You have to think about the different conditions or event, considering the aggregate, that they indicate that it is probable that the entity will be unable to meet its obligations. So what conditions or events, and don't just pick COVID only, there's a lot that can happen. But what conditions or events have happened that put you into a situation where the entity may not be able to meet its obligations as they become due when? Within 1 year, the financial statements are issued or available to be issued. That's the big consideration, and that's where we get into this big topic. And I'll give you one quick example. I don't know if they're on the call here. I will never give a client's name out, but I may give an example and may apply to you. And don't be Carly Simon, this is so vain, you probably think the song's about you type of thing. But Bridget and I were debating one day, talking about a client. I said, I'm looking at the financials, they cannot meet their obligations. And she said, well, they'll sell off assets. And I'm like, well, that's a different story now, because now we got to potentially have disclosure about them having to sell off assets. And we're not just talking about, oh, well, they have some investments they can get rid of, which is bad enough. You're just talking about selling off hard assets, and it's like, whoa. So there's a lot of things that come up. But what are examples of adverse conditions? And I'm going to give you a comment, and this is an editorial comment that I'll give you after I go through these items and give you the insight of a QC person. And you could say, well, it's very closed-minded insight, but it's just a quick comment. So some examples right off the bat: negative financial trends. Okay, I'll say it right now. When I QC financials in the office, and I see Liz is on here too, I'm not speaking for her, but when I QC financials in the office, I'm a third-party reader. I'm a third-party reviewer of the work papers. I'm an independent person of the engagement. So I pick it up as like a third-party reader, and I look over the financial statements, and I will tell you 4 things that I automatically look for to give me an initial indicator of potential going concern. These are 4 simple things. Now, I know that this is a very closed-minded way to look at it, but I have to look at it because as a reader, as a banker out there may be looking at it, as the public, as a potential buyer for a company, as a contributor to a nonprofit, they may look at these 4 things. So please respect that I'm looking at it as an outside person. I look at your working capital, current assets, current liabilities, especially if it's negative. I look at working capital. I look to see if you have negative equity, okay, and negative retained earnings and negative equity. I look to see if you have recurring losses, and I look to see if you have negative cash flow from operations. Those 4 things, I looked at them. If I see, and of course I'm talking significance too, and it also depends on my mood probably. I'm sure I annoy millions of people in my office, my wife included in there too. If I see working capital is virtually 1-to-1 or 0.99, I'm like negative, it's 0.99. I try and be rational with this, and some people will kick back and say, Brad, stop it. You're being out of control here. And I'm like, okay, yeah, it was a bad day when I was looking at it. But those are 4 things I will tell you, just as a quick third-party reviewer, I look for automatically. And as management, you should be looking your financial statements just on the surface as that. Yeah, you can't judge a book by its cover. You can't just look at the foreword. You've got to look at all the pages too, Brad. You've got to look at the footnotes. That's what they're there for. You've got to hear management's comments. Yes, that's what it's there for. However, Think about a third-party viewer, your banker, when they pick up your financials. I know there's some bankers on here today. I know that they're looking at some of this financial information, the footnotes, but they're not enjoying the footnotes like I am. So think about those 4 items. I'll be happy to give them to same to you anytime. Those are mine. Somebody like Ron in my office, or somebody like Mike LaForge, who's super analytical, will look at other things. Okay. Other indications, possible financial difficulties, for example, default on loans. Okay, there's where I go into the footnotes, or there's where I go into the work papers, and I see that now there's a default on the loan of the covenants. And now we've got the 4 conditions, I'm thinking, and now I start diving in a little bit more, and you start hearing a little bit more. As soon as we see that somebody has defaulted on their covenants, hence the reason we've got to get a waiver. And of course, depends on significance. You know, if we got a $200 million balance sheet with $100 million in cash and they defaulted on a loan for $100,000, I don't think that's possibly a going concern. I know there's other factors to consider, but if they've got no cash, you know, receivables that they got to collect, and inventory they got to sell to collect the receivables, and they have a violation of a covenant of $5 million line, that could be called at any second, and the bank's been talking about workout. Those are certain indicators. Some internal matters, you know, labor disputes, substantial dependency on certain products, and then external matters, legal proceedings, legislations, COVID. I don't have it. There was just a joke there, you know, like I don't know my house anyway. But this is not all inclusive either. Keep that in mind. This is not all inclusive. These are just general examples of adverse conditions, and there can be others that we as auditors have to consider if you've evaluated that. You'll hear about that later on. When evaluating the entity's ability to meet its obligations, okay, management should consider the qualitative and quantitative aspects about the following conditions: the entity's current financial condition, okay, the entity's conditional or unconditional obligations due to anticipated within 1 year, and the funds necessary to meet the entity's continuing operations. Now, if you're in a nonprofit community, I know I've referenced them a lot, but nonprofit community has actually addressed this to some extent, or as the FASB with the nonprofit community has addressed that C a little bit in their footnotes. Non-public entities really haven't gone down this route yet. Public entities have it with the MD&A and stuff like that. Non-public entities haven't gone down this route yet, but nonprofits have a footnote, liquidity footnote now, that kind of tells the reader of their ability to meet the obligations within a particular window that they've defined. Okay, I can let Kristen and Bridget, I know Kristen done a presentation on it, and then Tara, Ron do a whole presentation on the required liquidity disclosures. We've had a lot of discussion about our office, especially when I QC it. I jump all over that. So you have to consider your ability to meet not just the obligations that are sitting on the balance sheet, but also your continuing operations as it goes along. With that, I keep looking at the time. I will put out the next poll. So what indicators have you seen? I don't know if it's I don't know if there's a lag as to this coming out. Okay. And these are indicators of going concern. Wow, we got, oh no, I thought a lot of people answered already. So last slide, you can see some people are starting to have some discussions about it. I will tell you, in our office, we've had a lot of discussions about this before COVID. So when I say literally in our office, we've had it. So it's pre-March 13th, and they've been even heated discussions about this. And I'm sure that those that are not in public accounting, you know, when the auditor brings it up or accountant brings it up, you have a heated discussion with them too. But you have to see what the requirements are and why we talk about this, especially when you look at those indicators. So I'll go back to the Q&A. Recurring losses is the biggest, current economics, and certain people say not applicable. Some people said not regulatory, which is interesting. I don't know if I put in there regulatory as to, I was thinking also government shutdowns. That could be under current economics. Either way, it's a polling question to make sure you're awake. But if those are interested, okay. Nothing in the Q&A. Well, I can't be doing that good. Let's be honest. I even have a question about stuff I said. Okay. Continuing on. Examples of management's plans that they may implement to mitigate. So here's what happens. Let's take a step back. You determine, and you have to evaluate, and you determine if certain events or conditions have occurred. Then you determine what's management's possibility to, continue on, and what plans could they possibly have. And then you have to think, okay, is it a potential going concern? And do we have the going concern situation? You have to put that situation in there. It's a situation. It's BDS, Big Daddy Sitch. You have to consider, do you have a potential going concern situation? And do you have plans that can alleviate that? Okay. What type of plans can you have to help you alleviate the going concern situation? Well, you can dispose of assets. You can borrow money or restructure the debt. That's the most common that we see. Usually where I see going concern situations, of course, from losses. We'll talk about that in a little. That's my second item I'll say, because it goes to the next one. I see usually somebody blows a covenant, probably due to losses, okay? So somebody blows a covenant, and what do they have to do? They have to get the waiver. Now, they're not restructuring the debt, but they're getting the waiver, and we have to get the signed waiver. Something that was interesting years ago under IFRS, and I got to look back up into this. IFRS used to be of the position that you had to have gotten the waiver before year end. That's interesting. The way GAAP is now, if we identify the situation, management identifies the situation, evaluates if it puts us into a going concern situation, and you should get a waiver anyway, even if you aren't, but you get the waiver then. We've determined now you can make it from a year from issuance of financials, as long as provided the waiver takes it that far out. And all's good. Well, under IFRS mindset, I think they may have changed it, but under the old IFRS mindset, you have had to get that waiver before year end, because as of year end, you were in that situation. That was their thought process. I'm glad that we're using GAAP in this instance. Reduce or delay expenditure. So usually where I see, if it's not the blown covenant situation, then it is the economics, recurring losses, negative cash flow from operations, or negative working capital. So what do I usually see? The people are going to reduce or delay expenditures. Now, the one thing I hate about that delay expenditures is people say, well, I'm just not going to pay stuff, okay? It can't be the audit fee, because you can't have fees outstanding for more than a year because we're not independent, okay? But we're going to delay expenditures. Well, if we're talking about delay doing certain things, okay, but that kind of goes with reduce. But either way, reduce or delay, it's just a play on words. That's what I see a lot of time. People are going to restructure things. Usually what has to happen, though, if you're going to take that position or that stance, you're going to have to do some sort of forecast, and it has to be reliable, because you'll see later on about the audit. Increase ownership. What they don't indicate on here, and I see it a lot of times, is reliance on support, related party support for the most part. I'll talk about that when we get to the audit side. But I have seen that a lot, that so-and-so company, management, related company, owners will support the entity through, for the period that's required, in essence. Somebody asked a question, does it reflect different with interest-only deferrals versus 0%? If you're talking about interest-only, Courtney, if you're saying like payment of debt that's interest-only, I think that's what you mean, because I know your business. That sounds kind of weird. I know your business. Sound like I look like Popeye there too. But anyway, I know what business you're involved in. Yeah, I mean, what I've seen people do, Courtney, I don't know if this answers your question. What I've seen people do is, almost the forbearance type of mindset where they go to the bank and it's almost a restructuring and you say, okay, listen, we're not going to be able to pay principal, but we will pay interest only. Um, and, will that help? And if it helps the payment stream and helps your expenditure process, then absolutely. You're looking at all possibilities of ways that you're going to be able to satisfy the obligation of, or meeting the outstanding obligations as of that time. Now, let's not be crazy here. Don't play the game of 1 year and a day, and that the note is going to be called on 1 year and 2 days, and then it's going to put you into bankruptcy. But who cares? Because any lawyer is going to go after anything because you knew 1 year and 2 days was a death sentence compared to 1 year and a day. So just be careful with stuff like that. And I know you weren't even indicating that or insinuating that, Courtney. I'm saying it to the other people here, but you do have to, I would consider that, and hopefully I address it. If not, just ask the question again, and I'll try and restructure the question. I know people love flow charts. Who doesn't love one? I mean, everybody had the little graph that they used to be able to draw their own. So here's a little flow chart for you. So what happens now? What happens? So we've gone through that certain events or conditions exist. Okay, we know with COVID, it exists right now, and it's out there for everybody. Now, some people are doing better because of it. Good for them. I know a lot of people that are not. So just the fact that there's an event or a condition that existed, you should, of such magnitude, as management, you should at least have the thought process, has this affected me? Now, if I'm making hand sanitizer or if I'm making masks, I saw a big piece on 60 Minutes about it. I'm making masks. I'm anticipating these companies are making money. I don't have any clients in this industry, so I'm not saying anything about them. They should at least think, okay, COVID happened. Has it affected us? No. In an adverse way? No. We're going to make obligations. They've evaluated the situation. That's all they have to do. You just have to think about it, and should you have it in writing? That's part of a good control process. Those that have been affected, now you've got to go through the next steps of how significant is this? Okay, is this affecting my ability to continue and meet obligations for the next year? Okay, you have to have this evaluation, and now you have to put yourself in the shoes of the reader and determine how they're viewing it. So again, it gets to magnitude and significance, and I'm telling you, I see her on here. Bridget and I, we've had some big debates on this. She tries to help and defend the clients. I give her credit. And I just remember one of the last debates we had about it was right before COVID hit, and she was saying that management did not feel that the events or condition would raise it to a substantial doubt. And I said, well, can you just indicate why? And and it was two situations we argued about in 2 different weeks. And I know you just think that we're sitting here, she's not the arguer, I'm the arguer. That's definite. But it was 2 situations in 2 weeks, and one, she was able to show how they have the ability based on investments that were there to be sold off. And I'm not talking about just selling wholesale investments that got rid of wipe out the whole balance sheet, but they were able to make it within the year. And the reader should be able to see that too. Plus there's a liquidity footnote, but the other one where they just did not have the ability and the client was pushing back on it. But the problem is that the reader then starts looking at this, and there's clearly indicators that have happened. They're losing money. Okay, revenue's down. Wasn't even COVID related. There were a lot of indicators, and so I felt that disclosure was required. Okay, because there's certain instances as a QC person, I felt disclosure was required. Now, where you put this disclosure is up for debate and up for discussion. Okay. I'm a practical person. While I do a lot of QC. Alan Sobel will think that I'm just Joe GAAP. Mark, I see Mark Weber on here. He goes, "You're Mr. GAAP." I do believe that I try and be practical, where I'm not trying to bury stuff or hide stuff, but I don't want to alarm people. I've seen this put in the liquidity footnotes for nonprofits. I've seen this put in the accounting principles footnote for non-public entities, and not describe going concern, but describe future operations or something. But anyway, if you are required to have disclosures if there are certain events or circumstances about when substantial doubt is raised. Now, if you've alleviated it, if you think that you have in situations where it will alleviate the doubt, this is what you have to disclose: the conditions or events that raised the substantial doubt. This is what came about. COVID happened. Okay. Now, if somebody's in the hand sanitizer industry or the mask industry, I don't think that there was substantial doubt that was raised. Let's be honest. Now, if I have a restaurant, which I don't know if we have any restaurants in the office. Anyway, if I had a restaurant client, I think there's substantial doubt. Right off the bat, I think there's substantial doubt. Okay. Especially if it's in New York City or California, I think there's substantial doubt that we have to address, and it has to be put into the footnotes. They have to indicate the principal conditions. You can blame every governor or mayor you want. I don't care. Management's evaluation of the significance of those events or conditions, and management's plans that alleviate the substantial doubt. That's if it's alleviated. If you have ways, somebody's going to put money in, we're going to close the doors. I'm a restaurant. We're going to close the doors, shutter. We're going to have a lease abeyance for a while, whatever. You have to disclose it. That's if it's been alleviated. If it hasn't been alleviated, which means you are now in a going concern situation, okay, you have to describe the principles or conditions. Again, blame every governor or mayor you don't want. If you're a restaurant and that's who you want to blame, I don't care. Management's evaluation, management's plans that they intend to do to mitigate. Helping, okay, I'm not laughing at it, but you have to say it. If you look, those first three are the same as the last one. And now you have to include a paragraph in the footnotes indicating that there is substantial doubt about the entities to continue as a going concern. And that's what happens. One of the other reasons why I want to do this presentation is you try and have these discussions with clients or with management, and as soon as they hear it, they're like, "We're not doing going concern." Well, if it's alleviated, it's not going concern technically. It's been alleviated, but it's bringing the attention to the reader. But now, if it's not alleviated, you now are in a going concern situation, and you have to tell the reader that. Okay, and wait till we get to compilations later on. There's a lot of fun. So that's a disclosure. Here's a sample disclosure. In this instance, I don't know if I think both instances, we'll see when we get to the next one. Like it's a surprise. But here's an example of going concern situation. If you see at the very end, it indicated substantial doubt about the entity's ability to continue as a going concern within 1 year financial statements are issued. Okay. Sample footnote knows what it's called, going concern matters. All right, I'll just give it that way. This one was alleviated. So here we've described it. We've described the situation. And we said at the very bottom, accordingly, going concern doubts that existed at the end of the prior year have been alleviated. Okay. Now we talk about later on about if we had a going concern situation last year and it's been completely ameliorated, do we still have to show it in the next year? And the answer is no. I just ruined the big surprise. So I'm going to tell you what you're getting for the holidays next too, I guess. So for IFRS versus GAAP, not a lot of stuff here. I told you about that wacky piece about at year end, but the important thing here for you to see is under IFRS, disclosures are required when management is aware of material uncertainties. They use some weird wording. I actually like GAAP's wording better. But material uncertainties related to events or conditions. However, under GAAP, disclosure required when there's substantial doubt about his abilities to continue as a going concern. Okay, here's a big one though. Under IFRS, the assessment period is at least 1 year from from the financial statement date. And everybody's like, that's the way we used to be. Nope. It's at least 1 year from the balance sheet date with no upper limit. So they are on the mindset of the foreseeable future. So when I was at another firm, we had a client that made the plushie toys, stuffed animals. In the industry, called plushies. And they had a license for the pen plushie, you know, and they knew in 3 years they were losing that license. It was going away and it was going to somebody else. That would be a going concern situation. I mean, it should be disclosed in any GAAP financial anyway, but under IFRS, that could be a potential going concern situation now, because your only license that you have and your most profitable license that you have is going away. And that's in the foreseeable future. Whereas US GAAP, you would still have to disclose that under concentrations, but it may not be a going concern situation. Okay, so we've made it this far. Next slides will go quick. And since I'm watching the time, we'll talk about the impairment of that. We've made it this far, and you understand how this is all dumped onto management. If I lose you guys, I'll come back on, but I just got a notification my network is unstable. I occasionally think like my wife is outside just playing with the plugs and stuff. It's like, let me drive him crazy like he does me. So anyway, you see how it's put on you, and I know that the debates will continue as to if a certain event or condition exists. What you really have to do, and I know that this is difficult because people are very prideful of their financial statements, and I'm saying that with as much admiration as possible. You have to think about the reader of your financial statements, and you want to tell the story so that they understand it and you clear up the situation. If you don't believe that, I know that there are people that are on here that have gone through mergers and acquisitions, and these questions come up. And if it was just explained earlier, sometimes it would help a little bit better. Or the bankers, you know, if they're reading the footnotes, it helps with them, especially if they're going through their credit review. Explain it, because you know some wacky underwriter sitting behind the doors over there, like me being the QC on the door over there, is just looking at a metrics and wondering how could they not be a going concern situation. And if you think it was alleviated, that's great. Now you identified that it's a going concern situation, but you've also indicated that it's been alleviated, and now it's up for a judgment call. But without addressing it, it's like you haven't even considered it. How do I know this? The PCOB asked us about it on one of our clients, and they just sat there and just rode us like a cheap pony in the park. You know, it's like, you didn't consider it. It's like, oh my gosh, management's going to support you. No. And then no. You know, Mary Ellen and I went through, it was just terrible. So anyway, I know nobody on here that I know is a public entity, but you just have to think about all the other aspects too. And the debates will continue. So what's the auditor's responsibility on this, and why are we annoying you? That's what it comes down to, because effective December 15, 2017, for periods ending after, kind of lines up with the GAAP too. SAS 132 came out, and we are responsible now to conclude on the audit evidence if the financial statements are presented properly, pretty much, and evaluate the possible effects on the financial statements. Now, you got to love this. For a reasonable period of time. That's what they said in GAAP, for a reasonable period of time. And I panicked when I saw that. I'm like, you've got to be kidding me. Like I was, you know, yelling at my kid. Well, the reasonable period of time, the reason why they said that is for the reasonable period of time as addressed in the applicable framework of accounting. So if you're using IFRS, you should use their time. If you're using GAAP, it's 1 year of the financial statements are issued or available to be issued. So that's why they kind of left it vague, because you could be auditing financials in accordance with IFRS. You should use their time frame. GAAP, you should use that time frame. Okay. When management is required to make a specific evaluation, where certain events or conditions exist, the auditor has to look at the degree of uncertainty associated with the outcomes or conditions, the size or complexity of the entity. All right. Now, if you have, if you're a store that just sells widgets, I'm not saying widgets aren't complex, but it might be fairly simple. You know, we're closed down because, or a restaurant, we're closed down because we can't open because of the environment going on. Okay, but now if you have multiple locations of a manufacturer and different processes and different unions, it might be more complex that you have to consider as the auditor. I know Santo's on here saying, well, Brad, come on, that real estate that we talked about was pretty easy. Santo and I had a debate about a real estate company being a going concern. And he's saying, didn't sound complex to me, Brad, so touche. Any judgment about the future based on conditions or events that are reasonably known or should have been known? Okay, and this is we as the auditor have to think about this stuff. And then you'll see later on, we ultimately have to question you about that. Excuse me a second. Ultimately have to question you about it. And I know it's annoying, but this is what's promulgated upon us. And then you have your manager, your manager, your partner asking you this type of stuff. And then it goes through QC and you have us asking about it, and then it goes to peer review and you have them, us and them asking about it. And then if you have somebody else examining papers or an M&A and it goes through and they want to look at our work papers and asking about it, and it's best if you would, as management, if you address it and have it documented somewhere. It avoids the conversation down the road of you going, I don't know, I'm not too sure. When management is not required to make a specific evaluation under applicable framework or standards. So what this is saying here is, right, I got it. You're talking about GAAP. You're talking about IFRS. Guess what I'm going to do? I'm going to do tax basis. Well, going concern is a fundamental consideration pretty much across the board of all financial statements. Tax basis may not say it. Cash basis may not say it. Contractual basis may not say it. I pick little country GAAP that may not say it. However, it is a fundamental thought of the financial statements are prepared on a going concern basis, i.e. will continue for the not foreseeable future, 1 year and a day from issuance of financial. Okay, so if it's absent that verbiage or guidance, you kind of have to superimpose that over, and as the auditor you have to think about that too. Hence, management should be thinking about it. Risk assessment procedures. So for those, and this is boring everybody else, I know that it's not in public, you have to incorporate into your planning of the job. Polling questions, yes, Marty, it's a couple minutes, about 2 minutes, it's going to come out. So in planning stage of the audit, you do have to consider if the whole process of going concern has management evaluated it? Okay, will they be evaluated? What conditions possibly came up during the year? And this is, you have to plan this and consider this during the planning stage of your engagement. Okay, which means towards management, we have to ask about this even earlier, and then we again have to ask about it at the end. Boom, boom, boom. Okay, so for Marty, let's send out a poll. I know. What happened? Poll, close, open. Nope, queued. Uh-oh. Okay. No. Do later. What happened? So it says, have you considered impairment of assets? Submit. Okay. Polls looked weird. I don't know what happened there, Colleen. I know I screwed something up. So have you considered impairment of assets? And that's going to lead into the next section that we talk about. Okay, so while that's going, 5 said yes. Some said yes, they considered, but it's not applicable. Some are still evaluating, and 18 said no. 19. So for the 18-19, I hope you're all in making masks and hand sanitizer, because you really should be considering, especially this environment. And all I said was considering it. That was it. I didn't say booking it. I didn't say measuring it. I just said considering it. Okay. You have to review. We have to review management's plans, address management's evaluation. And that's somewhere where that we always get hit on of, have you considered management's plan even, or their evaluation process? First is, what has management evaluated it? If they haven't evaluated it, and they should be, That's a problem. You'll see it later on. Does their evaluation cover the same period? Okay, that they are anticipating, and does it include consideration of whether management's evaluation includes all relevant information which the auditor thinks auditor is aware. Okay. Of course, we have inquiries that we have to go through. There's additional procedures here. I won't bore you, especially since I see a lot of people here are not in public accounting, and even those that are at Sobel and Company. If you have questions about this, you can call me. We don't need to bore the people with our fun audit discussions. But the big one I wanted to see here, as you see here, is B, evaluating management's plans in relation to going concern evaluation. Love that. And by the way, that's taken from the pronouncement. Evaluate management's plans regarding going concern evaluation. So we have to evaluate the evaluation with regards to management's plan to effectively implement the plans to mitigate if the plans would mitigate the relevant conditions, etc. Okay, so I mentioned it before that one of the ways that people will mitigate a situation is they get support from a third party. Now, I say third party support letter, but it could also be, it's usually a related party. I don't think third parties are just going to support you, you know? So I'm walking down the street the other day, I see a company in a going concern situation, I say, I'm going to support you. I don't think we see that a lot. I think what usually happens is management related party will support the organization, or related company will support the organization should they need it in the for the year and a day. I keep referring to that, but you know what I mean. What should happen is we will have to get somebody to rep as to that, the management representation as to that. We may need something from the person that is going to support to say that they will support it. Usually it's disclosed in the footnotes that a related party has committed to support the organization through its operations. Okay, that's usually referenced. The tough thing is we have to audit that that support. So what I usually see is John Doe, owner, will support the organization, you know, for the you know, first, I say foreseeable future, for the year. I have to audit if John Doe can support that organization. That means get a personal financial statement. You know, and you know, I had one auditor say, well, I got there a list of John's investments. John has a ton of investments. That's great, but John also has a ton of debt. John's mortgaged out the wazoo, and that's a technical term. I said, John can't make it. So I don't know how John's going to support, because John's having trouble himself or herself. So we have to audit that now. So I'm saying you have to be careful about it, but you have to understand that we just have to ask questions. Why? Management does have to make representations to not just the third party, but also the going concern matters, their plans to mitigate or alleviate the situation. Okay. The auditor's responsibility on reporting. I'm going to make it pretty straightforward. If management's required to perform the evaluation, if we as auditors have determined that management should have made an evaluation and management refuses to, okay, then we have to issue pretty much an adverse opinion. I don't usually see this. But anyway, we have to put it out there. It's like the old textbooks. If the client won't do what they're doing, you should disengage. I see that a lot. I was joking. If after consider the conditions or events and management's plans, the auditor concludes substantial doubt about entities going concern, continue as a going concern for a future auditor should include an emphasis matter paragraph. So if management's done the evaluation, management has concluded they can't alleviate the situation, and the auditor reviews and agrees everything, we have to have the emphasis of matter paragraph. Okay? Let me repeat that. If there's a going concern, there's events or conditions, they are not going to be alleviated. It's been disclosed. It is a going concern situation. We have to have the emphasis of matter paragraph. Okay. What I don't have in here is if management has performed the evaluation, If there's events or conditions, management has evaluated it. Management has determined they can alleviate or mitigate the situation. And they have disclosed that. And auditor reviews and agrees that the situation will be mitigated or has been alleviated, we don't have to have the emphasis of matter paragraph. You can, and if it's significant. I saw somebody say this, it was really, really significant, even though they've alleviated the situation. You should have it. We had it when somebody said that to us because it was just so egregious. The company had no operations. Management was going to continue, but management was also going to support and had the ability. Somebody said, sure, it was alleviated, but it is so significant. You should have disclosed it. You don't have to, but you should have. So it was a judgment difference there. We go on a little bit more, and you could read these. What happens if management doesn't do what the auditor thinks should be done. This is not stuff that should come up at the very end, okay? And that's why in the planning stage, we need to have these conversations more than we usually do. Here's a couple of reporting examples. Again, these are reporting examples where it is a continued going concern situation that has not been mitigated. Okay, I can probably show you one where it has been mitigated or alleviated. We usually don't put that in there. I know clients hate the going concern disclosure and double hate the going concern paragraph or the emphasis of matter paragraph. Okay, and if they've alleviated it, they don't want the disclosure in general, but I push real hard to them to get that in there. And if I have to give up on the emphasis of matter paragraph, if it's not so egregious, okay, but as long as they have it disclosed, at least I feel confident that financial statements are conformance with GAAP and the disclosures are adequate. Okay. For the auditor and for management, we have to communicate with governance these matters. We have to. Some people are controllers on the call, and I'm not saying anything bad, but they're not part of governance. Governance are the owners, the board of directors. That's usually governance. They have to be made aware of this. We have sometimes executive directors are not part of governance. The board of directors is who we are reporting to. They're the ones that hire us theoretically. I know the controller in our relationships, and I'm not dismissing that or discounting that in any way, but we are responsible to usually the shareholders or the board of directors. Accordingly, we have to report to them. Couple of things on review. Review came out with the SARS Statement of Standards and Accounting and Review Services 24, which is effective June 15, 2019. The accountant should perform a review or perform review procedures relating to the following: whether a going concern is appropriate, management's evaluation. It keeps going back to management's evaluation. I'm sorry. If there's conditions or events that raise substantial doubt, and the adequacy of related disclosures. Okay, requires the accountant to include an emphasis of matter paragraph if the going concern situation still exists. And again, it's for a reasonable period of time. Remember, audits and reviews discuss reasonable period of time because it relates to the framework of accounting that the company uses. Under GAAP, it's a year from the issuance of financial statements or the date they're available to be issued. If management refuses to do all this, then you have other things that you have to consider under the frameworks of the guidance in the SARS. The last thing I'm going to discuss, and I'll do a poll, and then we'll talk about impairments. And those that don't want to hang out don't have to hang out. But Colleen and I said we got nothing better to do, so let's hang out, talk about accounting. Compilation engagements. Well, how did that come up? Has COVID affected your company? Is somebody issuing these polls? Okay. I think somebody took over my polls. Colleen, is there a ghost? The ghost of polling past. It is Christmas Carol. It's a Christmas Carol. Oh, boy. Anyway, so yes, negative COVID. So here's the big one. Compilations. So somebody says, I don't have to consider myself a going concern. It's a compilation. And I hear it in my office, Scott. Okay? It's not it. This is a GAAP issue. This doesn't have to do with audit reviews or comps. If you have a comp with disclosure, you have to consider if it is a going concern situation or if there are events or circumstances that created this to consider, and it's been alleviated. Now, where does it come in though? If it is a comp with no disclosure, what do you do? Comp with no disclosure, you are not required to present it, okay? I say that. You're not required to present it, and I say that with trepidation, okay? Because, and I know this is now me covering ourselves, and I apologize for this. And being honest, I'm about to be honest, just as my network becomes unstable again, you may not hear the surprise. Anyway, what you have to understand is that somebody is relying on these financial statements to some extent, okay? And this is what we realize. And I talk with an attorney about this, and I see, somebody's relying on it. And if it's a going concern situation, and you issue a compilation report, and management issues a compilation with no disclosures, and they go bankrupt, they go out of business, there's going to be lawsuits. So what do we do? And this is what we've recommended for a bunch of clients, and I've recommended to other practitioners and people that prepare financial statements. If you have a financial statement that omits substantially all disclosures, that's what the compilation report says, substantially all disclosures. Doesn't say it omits all, substantially all. You can issue a financial statement that includes just disclosure as it relates to the going concern situation. And that's what we've done. It's called selected disclosures. I recommend it. Let's put it this way. If you're in that much of a situation, you're potentially going to not make it through the year. People kind of see it. It's better to put it down, though, and identify it and say something about it. Because if something happens, they'll be like, I had no idea. Okay? Cover yourself. And we have to cover ourselves. You should cover yourself, too. Okay? That's my recommendation. If you have a compilation that omits substantially all disclosure, have selected disclosure, and just disclose the going concern situation. Okay? Again, COVID-19 is really what is driving me. Well, first, this came out a while ago, and people haven't been addressing it, but now with COVID-19, we do address it. Some of the issues as it relates to delaying financial statements, the effects on your banking relationships, okay? And I keep getting this network unstable. And let's just jump. I said if you stay around with me to 10:15, I will tell Valerie to issue the certificates with an hour and a half instead of an hour. I'm watching the attendees. We still have a bunch of you on here. I'm going to switch. Colleen, do you know how I switch handouts? I only see going concern. What's offers? I don't know offers. Oh, I just lost my slides. Colleen, do you know how to switch the handouts to the impairment?
Brad, can you hear me?
What was that? It's
Colleen.
Yeah.
It's the voice of reason. The person that's been doing your polling questions. Click on slides on the top right.
Top right.
So
slides. There it is. I was clicking the wrong one. I'm sorry.
That's okay. And then you pick which one you want to show.
Yep. Okay.
All right.
So let's talk about impairment. I was clicking on the other slides. Okay. Thank you, Colleen. That was Colleen's voice, by the way, for those that don't know who the producer behind all these unbelievable presentations we've done this year. Thank you very much, Colleen. All right. So what goes along with going concern? Impairment. Why am I discussing this? And really, thanks for staying on with this. Again, real quick, confusing statements expressed here are my own and don't reflect those of Sobel and Company. Okay. The accounting guidance impairment of assets is under 3 different areas. You either have long-lived assets, goodwill, or indefinite-lived intangible assets. And that's where you can find the guidance if you really need to read up. What's a long-lived asset? And I love this about GAAP. We define things based on something it is not. Okay? Long-lived assets are non-current, non-financial assets. Other than, this is just a partial list, goodwill, indefinite life intangibles, servicing assets, and deferred tax assets. Indefinite lived intangibles are intangibles that have no legal, regulatory, contractual, I didn't know this one, competitive, economic, or other factors limiting its life. I've always known legal, regulatory, contractual. I didn't know about the other one. I thought that was really interesting. I know I find stupid things I find interesting, okay? Goodwill is the excess purchase price. I won't go into that a lot. When should you test for impairment? Okay? I have this discussion and debate in my office during peer reviews a lot. When should we be testing for impairment? Well, for goodwill, you should be testing annually, and indefinite lives intangibles should be testing annually. There is a new ASU out there that makes it easier for testing, and this kind of it doesn't talk about it, but it kind of blends in some of the stuff, but you should look into that new pronouncement that's coming out. But if you have goodwill or indefinite lives intangibles, even if you're amortizing your goodwill, you should still have to consider test annually. And when a trigger exists. Now, for long-lived assets, let's just say fixed assets for now. It's going to make it easy on the both of us. There are other long-lived assets, but for this discussion right now, fixed assets, okay? Test when a trigger exists, okay, Roy Rogers? So we go on. What are triggering events, though? First bullet under goodwill and long-lived assets, deterioration of general economic conditions. You can read through the rest, okay? But let's go back to my 4 factors that I look at. I will limit it to one significant factor here, or 2. Net losses, and you say, Brad, net losses, come on. The second big one I always look at is negative cash flow from operations. If I see negative cash flow from operations, not combined, but even individually or in the aggregate, and net losses, I automatically think potential for impairment. Here and on the next slide we're going to talk about. Okay, so deterioration of general economic conditions. COVID, yep. This is what's a big focus of the AICPA right now. And if your auditors and your accountants are not asking about this, is going to potentially be problems later on for them, which may be problems for you, because you don't want to have your financial statements have gone through a peer review and you find out that your financial statements have to be reissued because the peer reviewer identified something. And it's happened even with PCAOB, where they've told firms to tell the clients, or they've told the clients that the financial statements have to be reissued and be re-audited too. You don't want to have that. And you can go through the whole other list. How about long-lived assets? Okay, what I found interesting is they have a different list. It's much shorter, and they don't go in a similar order. So let's look. Decrease in market price of long-lived assets. Significant adverse condition or change, okay? The 4th bullet, current period operating cash flow combined with history of operating losses, okay? That's what I'm talking about. I had a conversation with our group down in Paoli, our business valuation group. And they do a lot of work as it relates to going concern valuation. I said, what the heck is going concern valuation? And what happens is if you are in a bankruptcy situation and you need your assets valued to be able to sell off or something, that's what they help with. They also get involved a lot with with impairment. And we had a great discussion about triggering events and what they determine. So if you have a discussion, unfortunately, you should discuss with our EAC group down in Paoli if you have valuation issues, going concern issues, and valuations. They're really in tune to this. Frank Miranda knows all about the ASCs, and it actually embarrasses me how much he knows about it. I don't think I know a lot about it. He knows a ton. Application for testing. Goodwill you should review at the reporting level. So if you have multiple subsidiaries or divisions, okay. Indefinite lives intangible assets, generally a single asset, the particular patent, okay. Long-lived assets you can look at as a particular group or a single asset. It all depends. And now I know that Frank and the group down there, I know that there was somebody on here. I forgot who was on here before. It wasn't Tom. Oh my gosh, he's a great guy. He's always on our team chats. I don't see his name. Um, they do a lot of equipment appraisal. It's a very odd one. Not they're odd. It's very odd because you hear real estate appraisal, which yeah they do, but equipment appraisal. And this is where they get pulled in. And with what's going on with COVID, because I had a discussion with other A&A people about this, and we'll talk about it a little bit more. I'm watching the time. I'm going to kind of go through these quick because I wasn't anticipating giving this. The measurement of recognition for impairment, goodwill is at fair value. Okay, indefinite lives intangible at fair value. Long-lived assets has to go through a two-step process. First, you look at undiscounted cash flows. If it's negative, it's a recoverability test. If it's negative, then you go to fair value. Okay. The recognition of impairment is the excess of the carrying value over the fair value. So if you're carrying something at $1 million and it's only worth the fair value is $800,000, you have a $200,000 fair value impairment. This is the recoverability test. Is very straightforward. Undiscounted cash flows minus carrying amount. If it's a surplus, stop. Okay, undiscounted cash flows. Thing is, you got to come up with the cash flows. All right. Fair value. So you have a market approach, okay, which includes quoted prices. You have an income approach, which converts future cash flows of an income stream, okay, or you have the cost approach. Now, this is public knowledge, okay. I audited a baseball stadium at one point, not Yankee Stadium, not Giant Stadium. That's not baseball, by the way, except for in San Francisco. It was a different one. I won't go into details, but it was a public company, and it was carried on the books for $12 million. And they got an appraisal done to reduce real estate taxes. What do you think they do when they're doing an appraisal for real estate taxes? Drive down the value, drive down the value. So they handed it to me. And I looked at it, and it said the cost approach, which is pretty much the replacement value, it was worth $9 million. It's carried at 12. 12 minus 9 is $3 million. Gave it to my managing partner to look at. It wasn't Alan, although Alan would pick up on this too. Gave it to my managing partner to look at. And he said, got a little bit of a problem here. I said, what's that? He said, in the back, it gives the income approach. How much income is it going to generate? And according to that, it's only worth $900,000. Oh my gosh, you got to take the lower. You got to take the lower. It doesn't matter what you can rebuild it for. You can rebuild a Toyota and put it in the desert. If you have no gas, it doesn't matter. Okay? It's worth nothing. Doesn't matter what it costs you to build that Toyota. So it was $900,000. We had an $11.1 million impairment in 1 year. Yeah, they weren't too happy, but they went and got the appraisal. They actually told me that the appraiser was lying. He was just trying to reduce the real estate taxes. I said, well, I need the appraiser to put that in writing. And they said he won't do that. And I said, well, I can't do it because you're telling me he's lying. Just some general conditions. Under U.S. GAAP, reductions of carrying value cannot be reversed. That's the big issue. This is two reasons why I want to bring this up. We've gone through some significant times here. So there's some significant indicators which may tell you that you're in a going concern situation, or you have a potential impairment of long-lived assets, goodwill, or indefinite lives intangibles. You have to evaluate that, and we as auditors have to determine if events or conditions happen, have you evaluate going concern or impairments? We're going to be asking about it this year. I'm sorry. Okay. The bad thing is, and I wish GAAP would reverse this. I mean, you've got to come up to be able to prove what the fair value is, or talk with the business valuation people for them to be able to help you. We can't audit EAC's work, but they can help you and give you some thoughts. If you do have an impairment because of COVID and you can't prove that it's going to come back, and all of a sudden vaccines happen and everything comes back, you can't reverse it in GAAP. It's gone. It's gone. That's the unfortunate thing. And I'm surprised GAAP hasn't come out and said, listen, if it was COVID related, you can reverse it later on. That's the troubling thing about it. We accounting geeks were talking about this one day. Two other things I'll say real quick. If you have an indefinite lives intangible and you have an impairment, it now may become not indefinite lives and may now have a remaining life. If it's a long-lived asset and you write it down, that new value, what it wrote it down to is the new carrying value, and that's depreciated now over the remaining life, okay? If you have an asset that's held for sale, okay, and you write it down in value, you no longer depreciate it because it's anticipated the following. Management has proper authority to commit the sale. It's going to sell under its prior conditions, and it's immediately available for sale, and it's anticipated that the sale is going to happen within the year. That's why you don't depreciate it anymore. You do have a bunch of disclosures that have to happen, and then that's it. I asked you to just attend this presentation just so that you know what is required of management to evaluate and potentially disclose going concern situations, and even if it's been alleviated. And I wanted you to know what management's responsibility or a company's responsibility it is to consider impairment. We're in a bad time right here. I hope everybody's doing well with this whole COVID situation. I hope everybody fared the weather well. And I'll just close by saying, I hope everybody has a wonderful, happy, healthy holidays. Thank you for attending.